And yes, there's only two kinds of options, and we talked about calls. Now we're going to go look at puts. This one's very cool because you can make money when the market is going down. This is an option. It's a contract. It has elements, which is the money, the time, and the volatility. So here we're looking at making money when the stock goes down. The value of the option contract goes up. When it comes to expiry date, we're looking to make a profit. It needs to be below the strike price, and every penny that it goes below the strike price is more money for us. That's right, when it's going down, we're making money. So in this example, you can see a few different dates for expiry would have different profits. The deeper it goes to the downside, the more it makes. If it's above the strike price, the option is worthless. For now, we're talking about what the contract is worth at expiry. We don't trade it at expiry, but this is just to understand the value. So if the stock was a $90 price at the expiry date, but the strike price was $100, that's a $10 per share profit. And if we paid, for example, $5 per share, let's say a few weeks earlier, then we made 100% profit because our $10 profit on a $5 investment. That's pretty awesome. And here's how it works, is there's the in the money, there's the time and the volatility for the value that we would have paid the $5. Looking back at this point in the chart, let's just say that we paid $5 at that time. That's not the exact value, but we're just going to go use that as an idea. So in this case, at that point, the volatility was reasonable. It was close to the strike price. Now, when it's further away from the strike price, this is in the money. It's actually more expensive down there. Presuming the volatility was the same, the value would be higher. And here, it would be lower because it's closer to the strike. That's the in the money value of an option that hasn't expired. Now let's go talk about the volatility. In this case, if the volatility starts to increase, that the price goes up and down more dramatically, then the value of the option goes up also. If the volatility is low, the value of the option goes down. The increase in cost due to volatility is because there's a chance you could make more money. So we've talked about the money and we've talked about the volatility affecting the value or the cost of an option before expiry. Now we're going to go talk about time. So if you have lots of time before the option expires, before it comes due, there's a chance that you could make a lot more money. It could move a lot more. In this example, this one actually went to a loss situation at expiry. But prior to expiry, the value of the option could be pretty high because it could go in your favor quite a lot. And in this way, more time is more money. Less time is less money. The closer you are to expiry, the less the option is worth. So in summary, the three things that affect the value of an option, how much it costs before expiry, is the volatility, how dramatically the price moves, the time, how much time there is before it expires, the chance to change, and how deeply it is in the money or not in the money. That means the actual profit that looks like it could happen. And due to those reasons, the option value could be expensive or it could be cheap, depending on the volatility, the time, and how deeply it is in the money. Now you also know what determines the cost of a put option. It's very similar to call, except if the price goes down, we're making money, not if it goes up. What we really want to also know, though, is how do we make a profit? It's very much like making a profit with a call, except we're looking for short bursts in movement to the downside, and we want to follow a plan for that. So one of the things, just as a reminder, is we don't hold the option to expiry. We buy and sell for a profit before it expires. We're looking for a movement in the downward direction. We get in, we get out, and that's it.